Good morning, everyone. Morning here in the United States, and good afternoon, good evening, wherever you are in the rest of the world. Thanks for joining us for this World Council of Credit Unions International Advocacy webinar, COVID-19 related non-performing loans and the challenges facing credit unions. My name is Greg Newman, Director of Communications for World Council. We've got a great agenda for you today, including presentations on the $2 trillion question, what's on the horizon for credit losses, by Osman Sattar, Director of European, Middle Eastern, and African, or EMEA, Financial Institutions at Standard & Poor's Global Ratings. We'll also have a presentation on the impact of non-performing loans on credit unions. That's going to be done by Steve Stapp. He is the President and CEO for Unitus Community Credit Union in Portland, Oregon. And finally, we'll have a Q&A session at the end, question and answer with Steve Stapp and also with Andrew Price, our Senior Vice President of International Advocacy here at World Council of Credit Unions. I want to note that if you have any questions as you're watching our speakers' presentations, please use the Q&A button at the bottom of the screen and type your questions in there. I will ask questions of the speakers at the end of their presentations. And also, I want to mention today's webinar is being recorded. It will be available later today on the World Council YouTube channel. That's at youtube.com/woku/WOCCU. We're going to start today with Osman Sattar. As the Director of EMEA Financial Institutions at S&P Global Ratings, his expertise is called on by S&P's EMEA credit analysts for complex accounting issues such as financial instruments, deferred tax, pensions, and other topics. His responsibilities also include providing IFRS training for credit analysts across the EMEA, and considering the impact of changes in IFRS on S&P's ratings criteria. He's also a key part of S&P's outreach efforts to the IASB, FASB, and regulators, and he sits on the IFRS Advisory Council. Prior to joining Standard & Poor's, Mr. Sattar was a senior associate at the UK Financial Services Authority. His presentation today is based on a recent report he published with his colleagues, The $2 Trillion Question, What's on the Horizon for Credit Losses? Osman Sattar, welcome, and thank you for joining us today.
Thank you very much, Greg, and thank you for inviting me to come and speak to you guys today. I'm very happy to do so. I'm hoping that everybody can see my slides. If not, please do shout out. So as Greg said, I'm going to talk a little bit about an article that we published last year, just giving our views on our expectations for credit losses for banks across the globe. It got a lot of traction, a lot of interest in the market, because I think we were one of the first to take a global perspective. And so I'm going to talk through some of the key points from that report, and hopefully the report is available to you at the end of the slide deck. I've got a resource, a website that you can download the report and all of our kind of articles that are available in the public domain on the global banking sector.
Osman, I'm just going to interrupt you real quickly. We are not seeing your slides, so
I do apologize. Let me try one more time.
All right. There we go.
Fantastic. Okay. So let me make a start. I'm going to kind of go through the key messages in the slide, which are really kind of a few headlines, and I'll give the headlines first. I think that's always helpful just to set the context, and I'll talk a bit about each of those points in a little bit more detail. Some of the slides I'll go through quite quickly, but we will leave some time at the end for Q&A. So if you need me to go back on anything, or if you have other questions, we can cover those off. So first of all, as the title of the article indicates, for banks across the globe, we forecast that credit losses will be about $2.1 trillion for 2020 and 2021, spurred by the COVID-19 pandemic. The majority of that we're expecting will come through has come through in 2020. We still have to wait for banks' year-end reports, but we do expect around 1.3 million for 2020, which is double the level of 2019. Now that said, we do expect that even with those elevated losses, we think that by and large banks will be able to absorb that from their pre-provision earnings. But really, there's very limited headroom for further losses that would then start to kind of overwhelm that year's earnings and start to kind of use up capital. The other thing to say is that that 2.1 trillion is not spread evenly around the globe, and I'll give a bit more detail on kind of the regional differences, but really it's APAC is the dominant factor, and then North America, Western Europe come in next. Now, clearly all of these estimates are very much predicated on what happens, and we have our base case scenario, which is kind of vaccines available and starting to be widely implemented by the second half, or sort of by the end of the first half of this year, maybe a little bit into the second half of this year. But really, there is clearly you will see. I mean, I'm sure you'll agree that there's a significant downside risk to our base case scenarios as well. So that's something to be aware of. Now, the other thing to say that I just want to kind of very briefly touch on, that we did publish this article late second half of last year. Clearly things are moving very quickly, and some of these estimates we'll be looking at again in the coming weeks, and we'll update the market if there's a need to. I think in very broad brush terms that the estimates still feel in the right ballpark. The one thing that may change a little bit is kind of the timing of those estimates. They may move a little bit more towards 2021 than in 2020. So the elongation of the credit losses may be a bit more than we had expected. And then the other thing to say is, I think, and I'll touch on this when I talk about the regional aspects, that the forecast for the US credit losses, we were quite negative when we published this article. They may get trimmed down a little bit because a lot of the recognition of the losses has happened last year as well. So that's the key takeaways, and this slide I'm not going to kind of dwell on, but really this is kind of that first key takeaway, 2.1 trillion. It's interesting just to compare that to 2019, where losses were 603 billion across the globe. And really, we think 2019 marked the end of a multi-year period of very benign credit losses across the world for banks for several years, actually. So, we think that 2020 will be more than double the 2019 level, and then slightly more optimistic in 2021, but still well above 2019 levels. So I think this is kind of one of those periods of time where there's a bit of a pivot and elevated credit losses for a number of years to come. Now, I then kind of want to touch a little bit on how does that affect the banks. And I mentioned earlier that the other headline that we have is that despite this elevated level of losses, we do think that banks across the world, they'll be able to absorb that uptake through pre-provision earnings. The way that we went about this is that we kind of looked at our top 200 rated banks, and we think they represent about 2/3 of global bank lending. So if we prorata that, we estimate that for these banks, these credit losses would absorb about 3/4 of their pre-provision earnings. And then in 2020 and then in 2021, that ratio that improves to about 40%. So we do think there's a little bit of headroom left, but clearly much less than previously. And just by way of comparison, that 2019 credit losses, the ratio was only about 30% of pre-provision earnings. So really, this just really demonstrates, I think, really clearly that with muted earnings, very low interest rates, compressing net interest margins, there's not much capacity left to absorb further losses from current earnings. And so if the pandemic proves to be a lot worse than our base case, that combination of higher losses, even lower earnings than we forecast, really will start to impact banks across the world. And one thing that our economists have said is, the economic damage associated with the pandemic being worse than we forecast or lasting longer than we forecast, the impact is non-linear. So, if recovery, for example, takes twice as long, the economic damage would be more than twice as big. And the other thing to say is, even in our base case, with a recovery towards the back end of 2021, I think, clearly as the tide turns, the fiscal support that is being provided by many governments across the world, that gets withdrawn, some of those fragilities in asset quality that may not yet be apparent will become more apparent. So I think even in a base case, that recovery will take some time. I talked a little bit about the difference of that headline figure, 2.1 trillion, hitting the globe differently across regions. And this slide, the next slide, will talk a little bit about that. So the first slide just shows the change in credit cost ratios from 2019 levels by region. Now, by credit cost ratios, I mean the cost of risk, and to make that even clearer, it's really credit losses as a proportion of customer loans. So we expect around about 160 basis points in 2020, which is kind of double the level of 2019. And actually, it's higher than the peak of the global financial crisis, where we estimate the credit cost ratio was about 100 basis points. Now, one thing to say on that point is, it's not a like-for-like comparison, the 2020 level with the global financial crisis. There's a couple of key things that have changed since then. First of all, we have more a timely recognition of credit losses, given the developments in accounting requirements. So we've moved from a incurred loss credit loss model, both in US GAAP and in IFRS, to a more forward-looking, more timely recognition of credit losses. So I think that's helpful, but it kind of distorts the comparison. The other thing to say is, compared to 2007, or 2008-9, the global financial crisis, the share of lending that is represented by emerging markets is higher now than it was then. And I think the quality of that lending, given the nature of those markets, tends to be a little bit lower quality than in developed markets. So that also has an influence. And I think the other thing to say is that the global financial crisis, although we call it a global financial crisis, it hit some regions, and particularly some countries in APAC, less than in North America and Western Europe. Whereas I think the pandemic is truly global, so it has affected every region and every country in the world. So I think there are some things to be aware of there. So although the credit losses are higher than the financial crisis, I think it's not a like-for-like comparison. I think the other thing to say is the quality and the quantum of capital that banks hold now compared to the darkest days of the financial crisis is very, very different as well. This is another way to look at the kind of large differences that we see across regions for credit losses. So here we're comparing 2020 and 2021 losses in aggregate compared with the 2019 level. And these regional differences do appear for a myriad of reasons. I think the first thing to say is, as you can see very clearly from this chart, China is a very large element of the total. And I think that's worth bearing in mind as to why that is. First of all, it's a very, very large element of the global banking system. In fact, if you take customer loans as your metric, the Chinese banking system is bigger than the US, Japanese, German, and UK banking systems combined. And I think that's something to bear in mind. And why is it so large? Well, clearly the size of the Chinese population and the size of the Chinese economy is huge. But also there's a very large reliance on banks in China compared, for example, to the US in terms of lending, where the US is a market that has bank lending, but also has a very deep, very liquid capital market that companies are able to utilize and borrow from. Whereas in China, it's very much focused on the banks being the key conduit for lending to the economy. I think the other thing to say is that Western Europe appears relatively small. I think that's partly, maybe even substantially, attributable to very substantial fiscal support schemes that we see across the world, but most particularly in Western Europe, is supporting kind of the asset quality, supporting borrowers, whether they're households or companies, and that has an impact on the scale of losses that European banks will suffer. I think the other thing to say, North America is large, larger than the US, but I think history does indicate that US banks tend to be more prompt, some would say more aggressive, in writing down potential problem loans much sooner than, for example, European banks, and maybe that will play out in the coming years as the proportion of losses reported by US banks becomes relatively smaller compared to, for example, European or Asia Pacific banks. So just bear this picture in mind, and particularly Western Europe perhaps, and also the US. As I move through the next slide, I think one thing that is kind of making the news, the $2.1 trillion figure not being even larger than that 2.1 trillion, is the fact that what we've seen is very substantial fiscal support from governments to households and businesses, supporting them, and whether that's through guaranteed loans, whether that's through very reduced interest rates, whether that's through mandating or encouraging bank forbearance to borrowers, or direct fiscal payments in some cases to households and to borrowers. I think that has really been a very defining feature of the current pandemic and the current level of losses that we are seeing in banks. I think one danger here is that if that fiscal support starts to be withdrawn too early, it will ultimately, or could ultimately, result in a very deep and elongated contraction. We're not seeing evidence of that at this point in time, but I think that is one risk that is something that we're mindful of. The other thing to say is, even as things improve, as our base case kind of indicates, and that fiscal support does get withdrawn in an orderly, rational, calm way, I think what that will reveal is that the fragilities that are in asset quality that are not obvious at the moment will become more and more clear, and maybe there'll be pockets of risk that have not been identified, or perhaps as clearly identified as they could be, will become clearer, and we may see some aspects of asset quality coming to the fore more clearly. And I guess that kind of leads me a little bit onto the concept of borrower forbearance, which banks have deployed with regulatory encouragement, or in some cases regulatory rules. And really, in the initial stages of the COVID-19 pandemic, and perhaps even now, it does make sense. It's intended to help borrowers bridge short-term liquidity constraints, stabilize borrowers' creditworthiness, prevent liquidity problems becoming insolvency problems and resulting in defaults on payments. So we don't see at the moment, that forbearance activity as an extend and pretend, as perhaps was more the case in the global financial crisis. It's not necessarily an automatic indication of decline in asset quality, but still, it's intended to be short term. We've already seen that those 3-month extensions or 3-month repayment holidays in many markets have been extended in a number of countries to 6 months or even longer in some cases, given that the recovery didn't happen as quickly as initially anticipated. So it's not something that we are saying is masking underlying asset quality problems to a great degree yet, but it is a risk that protracted for borrower forbearance does end up doing exactly that. And we're really very keen to see banks' year-end reporting, and the quality of disclosure, I think, will be a very, very important factor for investor confidence in those banks. One of the features of the global financial crisis was that investors really didn't trust the metrics that they were seeing from banks, and I think banks would do well to ensure that they are as transparent as possible in terms of their asset quality and their book. Finally, I just wanted to move on, if I may, to say a few words on the accounting. I touched on this at the beginning, where I said, comparing the level of losses now with the global financial crisis kind of is not like for like, given the enhancements that we've seen in accounting, both in IFRS with IFRS 9, but also in the US GAAP model with the CECL model and the current expected credit losses. I think one thing that we're mindful of is clearly, IFRS 9 and CECL are different in the sense that IFRS 9 requires you, for your performing loan book, to recognize a 12-month expected credit loss, and then for your non-performing, underperforming book, a lifetime loss. Whereas the CECL model, the US GAAP model, says, apply a lifetime expected credit loss model for your entire book. Now, at first glance, that seems, worlds apart, and I guess, it can be worlds apart. But at the same time, I do think, for the performing book, whether you take a lifetime or a 12-month loss, given that it's a performing book, maybe the differences will not be as large as might be apparent on the first thing. But it's something that I think still, given that CECL is relatively new, IFRS is a little bit more old, but still relatively new. I think the difference between those two approaches could be one reason why US bank credit losses have been marked by higher amounts than compared to some European banks, as an example. I think that may weigh on bank earnings initially, US bank earnings initially, but at least what it could mean is that their later provisions may end up being ultimately lower than European banks as they play catch up. So I think that's a very quick rattle through the article. You can access the article through spratings.com, and you can find our other commentaries on the same page. So many of the articles on there require registration, but then once you register, they are free to access. It's not our ratings database, which is a separate piece, but we do try and put as much on there as we can. So you're very welcome to take a look there. I was the lead author on the article, but clearly it was a global effort. So you're very welcome to reach out to me or to any of the names listed here if you have further questions or would like a further discussion. Very happy to do that with you guys. But that's everything I had for my presentation. Happy to take questions. I'll hand back to Greg.
Thanks so much, Osman. That's a really detailed overall worldwide view, and I think that's exactly what a lot of people here were looking for first, to kind of see how it all compares. We have some good questions in the queue. One comes from Kirk. He's asking, we are also seeing a reduction in the ECL calculations in the models we use in Canada. This seems to indicate that we were too pessimistic in early estimates of probabilities of default and forward-looking indicators. Government programs may also be more effective than originally estimated. Are other markets also finding they will release provisions early, or will it simply take 2 to 3 years to realize these losses and actual write-offs? And do you feel many models were too pessimistic in the early stages of the pandemic?
Great question. I touched on the US, perhaps, I indicated that we and indeed the banks themselves recognize a lot of less losses up front in the US market. And they, in their Q3 reports, they kind of indicated that they may see some write-backs in future periods. So I certainly, I think that Canada may be in a similar situation. If I look across to Western Europe, one of the things that we and indeed many other market participants were scratching our heads about a little bit at the half year and also at Q3 reporting is that, there was a bit of a dichotomy between, let's say, UK banks, Nordic banks, who recognize quite a large uptick in provisions versus Southern European banks, where the uptick was much, much smaller. And so what I think will emerge is a very mixed picture in terms of recognition of credit losses. I think, those banks that have taken more upfront may see some write-backs. I don't expect that at year end, frankly, in Europe. We may see it in the US and in Canada. But I think in Q1, Q2 this year, we may start to see some level of write-backs, particularly if the vaccination programs proceed as expected. But I think in Southern Europe, the process will be a bit slower, and we may continue to see elevated credit losses for some time longer. I think if I move across to APAC for a moment, I'm hesitant to speak in great detail about APAC because I think that's a bit of a moving feast. I think there's China, then there's the rest of APAC. And, to some extent, the pandemic there, not that it's over, but it's been better controlled and the impact has been a bit less. So it may be the case that it may be more akin to US and Canada than Europe. But honestly, I think it's a little bit difficult to say at this stage.
Another question we have actually here from World Council is wondering if you think there will be a market for securitizations for non-performing loans to help get bad loans off the books for both banks and credit unions.
Yes, that's another great question. I think, the European regulators have indicated that there will need to be a market for problem loans, and that was the case certainly before the pandemic hit Europe, but even more so the case now. Will there be? But your question was, will there be a market? Credit markets are awash with liquidity at the moment. There's cash maybe looking for a home. So I think there may well be a market, but I think where the pricing will be in that market, I think is the key point, and that hasn't yet emerged. So there could be some hesitation for banks to offload at much below book values. They will have written down, and whether that is acceptable to the buyers, I think time will tell. I think the incentives, the factors are there in terms of cash being available, liquidity in the market, investors being interested. It's just a question of whether banks are willing to take the price that investors may be willing to stomach. We're not in a situation, again, I'm sorry to keep going back to the global financial crisis, but it doesn't feel like we're in that situation where investors were very hesitant almost at any price to come into the market. I think that's a very different market now.
Very good. Osman, great presentation. We appreciate your time so much. If you'd be willing to stop sharing your screen, thank you very much. And again, if anybody wants someone else in your company and your credit union to see Osman's presentation, we will have this up on our YouTube channel later. We are going to switch gears right now and take a look at this issue from a credit union perspective. And we're going to be joined now by Steve Stapp. Steve is the President and CEO for Unitus Community Credit Union. He has been in that position in Portland, Oregon since 2016, where he serves a very dynamic membership base focused on technological advances, innovative products, and legendary member service. United has been recognized as one of the best places to work in the Portland area. Previously, Steve was the president and CEO of San Francisco Federal Credit Union and has worked at Redwood Credit Union and Golden One Credit Union as well. He sits on the board of directors for our Worldwide Foundation for Credit Unions and is the former board chair here at World Council. And he's speaking today to give us a firsthand account of the impact of non-performing loans on credit unions. Steve, thanks for joining us.
Hello there. Thank you for having me on this webinar. It's great to see all of you again and be part of this presentation. These are definitely challenging economic times, as we just heard from Osman, Sattar, and it's important that we take a look at this and we analyze this and see the impact that this has on an individual credit union. The coronavirus is impacting millions of people around the world. And in addition to the impact that we're having here with the coronavirus, we've also had social unrest and wildfires that further impacts some of the work that we're doing here in the United States. But first, I always have to say my heart goes out to anybody who has suffered the effects of this terrible disease and has lost a loved one. There is hope with the new vaccine, and although we're still preparing, we do know that there's still terrible days ahead. So it's really, as we saw this recent presentation, it's now trying to take that information and now how do we apply it to a specific credit union model? And that's exactly what I'd like to present here. So let me give you just a snapshot here of Unitus Community Credit Union. In dealing with non-performing loans, it's really the outcome of the impacts of the coronavirus is having. And in my presentation, I want to give you insight on how Unitus Community Credit Union has approached this. Each and every credit union will have a unique approach, and that should be tailored to your particular economic conditions. We just heard that the economic conditions around the world are different by region, by country, and that's the impacts that you have to consider. So the purpose of my presentation is just to give you some ideas of some of the considerations and what we've been considering here. And really it takes experience, it takes art, and it takes science to be able to analyze what's happening. So here's a snapshot of Unitus Community Credit Union. We're a community-based credit union in Portland, Oregon. That's the Pacific Northwest of the United States. We have been hit. The coronavirus first started in the Seattle area in the United States. And so we were one of the first areas or regions to be impacted. And of course, we've seen the impacts travel east and then back west. We have just over 100,000 members. And what I'm calling a fairly complex or mixed portfolio of loans. And you can see it kind of across the bottom there. We have a portfolio of residential loans, we have a portfolio of commercial loans, and we have a portfolio of mortgage loans. And each of these loan portfolios have unique characteristics about them. They perform differently. And then in addition, we have about 500 million in mortgage loans that are off balance sheet that we service. Assets of the credit union are just over 1.5 billion. And another aspect of the pandemic that we've experienced is about 20% growth in our shares and deposits. Obviously, that's caused some strain on our capital ratio, and that's been kind of an unintended consequence of the of the pandemic that was not foreseen going into this. We have 9 branches, plus a video and a virtual branch, and 280 employees. So that kind of gives you a thumbnail sketch of kind of our size and complexity as we've now are applying what's happening in these conditions. So non-performing loan management, this is obviously an area that we're spending a lot of time in. It's first, looking at our philosophy, and our philosophy, like many credit unions around the world, has not changed, but it's worth noting that it's a very different approach than the large banks. And what we just recently heard is, the large banks have implemented CECL. They're required to put away lots of reserves, and they're required to really have what I call kind of a forceful collection process with their customer base. Credit unions are different. We're member owned. We have a different philosophy in that we work with our members to try to work with them through these credit situations and really look at the impact that it has on our entire credit union. So underwriting and understanding the credit union at the beginning of the process is as important as the end process. And I think credit unions in general do a good job of that. We understand our members as they come in. I've heard several times somebody will come and say, hey, another bank will give me more in a loan line than we will. And I always remind them that they may not be as easy to work with on the end if they have difficulties or problems. So in building that relationship, we really guide our members through this process to making sure that it's good, sound credits that are coming in the process. But like everybody else, we will have challenges, and our members will have challenges that we'll need to work through. The external environment is what is obviously the very dynamic feature that's happening right now. And like most regions in the world, we've seen an uptick in coronavirus positive cases, hospitalizations, and deaths. And this has resulted in government intervention in attempts to slow the spread. And this has both a micro and a macro economic impact. In particular, we've been tracking the impacts of unemployment. So you'll see that here on this chart of what happened on our unemployment at the local level. So prior to COVID, we were at around 3%. As the economy shut down and those impacts happened, it spiked up to something that we had never seen before as quickly of a dramatic increase to 14.9%. And now it has come back down to 6%. So that's quite significant for us. But one of the factors that we look at that unemployment is, not everybody is at their pre-COVID employment. There may be overtime reductions. It may be also government stimulus is helping companies along. So although we're optimistic, we're also realists to look at these numbers and say, what else is this potentially telling us in this area? And businesses are really bringing employees back, but now we kind of go back into a second shutdown. And so this is kind of, as I said, a very fluid environment. And so we continue to see stress and difficulty and lost wages of our borrowers. One of the areas that we utilize as an organization, or a data set that we use that's not contained here, is what we call voice of the customer. So we actually have an analytical data set that examines our incoming calls, our incoming transactions, rates, and scores that information. So we can really track the call volume that we're receiving, the member feedback, and we can really kind of gauge the stress that they're under as we go through this process. So that's been really kind of anecdotal information that's helped us through this process. So now let's take a look at a specific portfolio considerations. And in this, you can see here are the many factors that we're using to analyze our individual portfolio. So it's really taking a combination of those data analytics and measuring the risk, and then looking at that and how it's changing over time. And just kind of, I think, as some of the questions stated here, we've seen some kind of pessimistic views, and maybe it's not as bad as it seems, or maybe it's going to be later, and we'll kind of I'll show you a chart of what that looks like for us in just a few moments. We did implement, as part of this process, as we went into this crisis, I think what was really, really important is we implemented an internal committee that I sponsored in our organization that we call our Reserve Adequacy Committee. This committee meets on a monthly basis, and we also have oversight by our Board of Finance Committee. And what this new committee does is we analyze on a monthly basis, what are the new economic trends, how has it changed? We look at what's happening in our portfolio, what's happening with the delinquency trend, what's happening with the charge-offs, what's happening with any individual credits that need our attention or look at. And then that helps us set what the allowance for loan loss should be. And then again, we do have oversight with our Board Finance Committee and then ultimately our Board of Directors, but it kind of provides that kind of multi-layer check into what we're doing. So just as this slide says, early case management is really important. So early identification and intervention. We're looking at maybe where credit, where borrowers are not making payments or where they're taking advantage of some of our programs to see what that stress may be. So some of the tools that we use is skip payments. So this is just simply, generally applies to our consumer loan portfolio, a pause of payments. So either a 30-day or a 90-day pause in payments. We generally, we would process maybe a couple hundred of these a year. And we processed over a couple thousand of them early in the pandemic. We were able to automate that on our system. And again, it gave our members that relief. The other one that's a little bit more complex and a little longer is the mortgage forbearance. And again, that's a pause for that member to make that payment. We have it in rolling 90-day increments where we're helping that borrower and we're listening to what they're telling us to see what those next steps are. Jumping back up a little bit here is on financial counseling. This was something that we implemented before we went into the pandemic and has really served our members well. And this is a third-party assistance for members in which they can kind of validate their situation. It takes it out of the credit union. It gives a third party an opportunity to talk with that member. We pay for that service, and it helps gives them the advice that they need during this pandemic. In some cases, they may need to liquidate their assets and they may need to redo their loans, but it really helps them guide through that process. Some of the longer term tools that we have is refinance. We've seen a really big boom in refinances of mortgages. And we've seen, the other tool is restructuring of debt. So we've seen more members take advantage of the refinance. If they've had difficulty, they were able to, as interest rates dropped, they were able to refinance that mortgage and lower that payment. Obviously, the other tool after we go through the forbearance process would be to restructure that debt. And in that case, we look at hardship modifications and we look at how that we can offer that debt relief. Again, our goal, especially if for anybody who has a home and it's their primary residence, we want to keep them in that home. In some cases, the criteria is a little different. If it's a second home or if they've abandoned the home, then that changes that. I think one of the important things that we've not seen in this crisis here in the United States is a decline in collateral values. So home values here in this market have stayed extremely strong. In fact, they've continued to increase. So that's very different than the last global financial crisis. Early on, we anticipated that maybe used auto loan valuations would drop. That was an early prediction. That hasn't occurred. Those values have remained very strong. So very different than the last recession where we saw collateral values drop. Those collateral values are holding very strong. And so, that last point there is, our final and ultimate step with a non-performing loan is collateral liquidation or legal recovery. And obviously we use that as a last resort tool. We use that very judiciously as we look at the credit. Again, we're not in the business of trying to get a car back or a home back. We're really in the business to help our members out, get them through this time period. But at the end, if we do need to pull that trigger, we will. Right now we have some local and nationwide rules in there that really allow us to, or do not allow us to foreclose on property. So again, we continue to work as closely as we can with our members. Now, kind of going to this next here is really taking a look at, there's differences between what we call regulatory accounting, that's our call report 5300, regulatory reporting, and generally accepted accounting principles. And there's kind of differences between these two areas. And one of the aspects that we have is the regulators have obviously given us some relief on how we handle our members, what we need to count as delinquency, that's anything 60 days or more delinquent. And so that really kind of brings down what I call that ratio. Generally accepted accounting principles apply, and the reversal of accrued interest or the suspension of accounting for that interest, that takes place. And what I always ask as we look at this, or as we look at our credit portfolios, really what's the real economic reality? And that's kind of the art. So we have the regulatory accounting, we have the general accepted accounting principles, but we have economic reality. And I think as CEOs, as chief financial officers, as people over credits, we really need to look at that reality and understand the accounting, but also understand what is the economic reality. And that's where we need to make sure that we've got adequate reserves down the road. So I always use analogies. So my analogy in this area is it's kind of driving down the freeway and it's a foggy, uncertain road. And mostly accounting has us looking in the rearview mirror. We're looking at what happened behind us, and that's what we're accounting for. And really finance and economics is having us look forward down the road and scanning and saying, well, what are the uncertainties down that road and what do we need to be prepared for? Because we can't see necessarily what's happening. And this pandemic and the economic impacts are having a long-lasting effect on institutions that we estimate will be 48 to 60 months. So although certain things are happening in the immediate, this may have a longer tail. So as I look at the graph that we've presented on this next slide, this is our projections, and this is, again, I'll go back to, this was our projections. So this chart represents how we've modeled the potential future losses, and we modeled that based upon our past experience. Most recently, and that's the gray dotted line in the middle, was our 2008-2009 global financial crisis. And we wanted to model through various scenarios. So the blue line is what we call our low end of the estimate. The orange line is in the middle there, and then the yellow line is the high line. And you can see it's kind of got different timing. Our timing we look at is 2021, but you're right, government intervention or other things that are happening in the economy may shift this curve into a longer time period. Now, with that projection, then we track it to what is actually happening. And so you can see the green line in this chart is our pre-COVID baseline. We were performing very, very well. We had very low charge-offs, very low delinquency. And then you'll see the red line, we actually started performing even better. But we anticipate that there will be a tick up because we just feel, or we just are seeing in the numbers that there's stress within the portfolio that will manifest itself. Now, will it manifest itself, to the blue line? We don't know, but we wanted to make sure that we were prepared as an organization with reserves to be able to handle that. So that's kind of how we've taken that, and now we can model this scenario and we can track this. And I think, as one of the individuals asked in a question, will we take back reserves? And I would say, over 3 or 4 years, if we look at this and we never did achieve what these projected losses are, we would do that. But by putting reserves away and anticipating this has helped us within the organization make other decisions to control expenses, to making sure we're preserving capital, making sure that we have liquidity on hand. So it's, I call it really a preparation type model. So if I look at the next slide, this is our forward looking. Again, this is COVID-19 is not an isolated event. It just didn't happen, and now it's automatically going to get better. We're really looking at this as probably a 48 to 60 month event on our balance sheet. So current performance may not represent what future performance is, and that's an important aspect as we look at our credits. The other thing that's really important is different asset classes will perform differently. Having been the World Council Chair, I know I've visited with credit unions throughout the world, and everybody has a unique portfolio. Some are more unsecured in their portfolio. Some are fully secured with concentration of mortgages, and everything's going to perform a little bit differently. And that's why there's no real cookie cutter in all of this that says, this is what you need to apply. And predictions may be incorrect. As I said early on, we have predictions that the used auto loan values would drop, and that hasn't happened. However, with that, we think there's unknown conditions that may present themselves in the next 6 months, year, and it's just really being cautious to making sure that we're looking at that. And again, when I went back to that RAP or the regulatory delinquency, it's showing a very, very low delinquency number for us because we don't need to count certain forbearance loans in that calculation for our regulators. We also calculate our delinquency with those forbearances in there because we know that portfolio is under stress. So we know with that higher delinquency number, that again keeps our attention and eye on that and in that constant monthly review. So, these are the variables we continue to track. We're looking at the regulatory and the government regulatory changes. We're looking at the unemployment very carefully, both at the macro level in the United States, but also locally. We're looking at, the COVID-19 vaccine, and that will help the economy get back on track, but that will, again, take some time before people are really comfortable with doing their, what we would call pre-COVID type activities. And we're really looking at what other market disruptions are there. We're having a lot of political disruption right now in the United States. How will that play out in this environment? And then finally, watching those collateral values. Home values for us and collateral values are holding very strong, but that's something that we carefully look at because that could potentially be a bubble. So I'm hopeful that these are useful considerations as we all navigate through these challenging times and we work with our members. And we're optimistic that we will come out of this, but it's just something that we all need to work together in making sure that we focus on. So with that, Greg, I turn it back to you and Andy.
Great, thanks so much, Steve. And I do want to bring in Andy Price as well now to help answer some questions. And if you do have questions for Steve or Andy, please write them into the Q&A section on the bottom of your screen. Andrew Price is our Senior Vice President of Advocacy, International Advocacy here at World Council. And Andy, I know you've been watching these presentations and kind of taking notes, and give me, I guess, your general impressions, and also kind of what jumped out at you and what jumps out at you in terms of questions for maybe Steve or if you had any observations.
Yeah, thank you. And Mr. Sattar's presentation, that $2.1 trillion number still scares the heck out of me. And let me talk about what we've seen from a regulatory response from the international standard setters and what I'm seeing around the world from national level regulators. Obviously, we've seen a confluence of relief measures that have been passed from the accounting standpoint, how you're calculating your expected losses. We've been given some relief on that, how you treat payment moratoriums, how you treat foreclosures, and a lot of those payment moratoriums and foreclosure relief and other collection reliefs are still in place. We're seeing those get renewed in many countries around the world. The Basel Committee has allowed the use of capital buffers to help through the crisis. We've seen a delay in the implementation of Basel for a year, and I suspect that there's some talk that might even get extended for yet another year. Mr. Sattar alluded to it, the fiscal support that's out there for individuals and how that gets withdrawn. My real concern is that there's going to be a confluence of all that withdrawal, and that may lead to, shocks to the system. So I think for regulators, how that is done, and if it's done in a responsible and easy manner, that will help. They were quick to provide the relief. I hope they're also as thoughtful as we start to come through the pandemic and do that. And so I was happy to, Steve talking about his plan on how he's preparing to deal with that and a lot of the unknowns in there. I'm just, my real concern is that we do this in a thoughtful manner and one that doesn't really shock the system, and that 2.1 trillion doesn't just come at us all at once. I think that's probably my biggest concern. So that's kind of my general comment on what I'm seeing from around the world.
Let me get to some of the questions we have from our attendees. Thomas, I think this is a question for you, Steve. Thomas asks, based on your non-performing loan management approach, what impact do you see on your loan loss reserves? More loans going into TDR status will trigger higher reserves. Do you anticipate the regulator forcing you to reserve more with extended forbearances, or do you have an idea when regulator tolerance for this will be ending?
Yeah, and that's an excellent question. And I would say, I feel like we're ahead of the regulators. We've actually had a pre-meeting with our regulators and shown them what they're doing, and they're very appreciative of the approach that we're taking. And so that's why I will say we're proactive. We've pretty much doubled our allowance for loan loss from where we started the pre-pandemic. So we've greatly added to those reserves. And now you can, in that chart that I had, we're tracking now to that actual. So we pre-funded to what I would call that low to medium range anticipated loss. Now we're tracking well below that at the current moment. And so our regulators are quite satisfied with that. And so, and I think that's each and every institution kind of has their risk tolerance. Some may not put as much reserves to this and may want to, negotiate or battle with the regulators. So for us, we take a different approach in that we want to be ahead of that curve and have adequate reserves. We are, and I think I saw the other question, we are, the delinquency is, for us, is very low, but when we add in those that are in forbearance or those that are in skip payments, it adds, for example, for us, our delinquency is about 0.16, which is extremely very low. But when we add that forbearance in there, it takes us to about 0.60. And now that's something we're watching very carefully, because as that ticks up, then that indicates we've got some stress in the portfolio that may manifest itself down the road. Now, it may not. Again, our collateral values for our mortgage forbearance is still very, very strong. So it may not ultimately result in a charge-off. But again, these are just things we want to be prepared and making sure that we're shored up on the reserves and the capital side to weather. We can weather through this. The question is, what's beyond the horizon? What's going to happen in the next year or the next 2 years or the next 3 years? It's now we can't see down that road. So that's the position that we've taken.
One of the things that has jumped out at me over the last 24 hours, we're expected to hear a speech, I think today, for President-elect Biden. And there have been reports out there that we're going to see trillions in new economic relief, new stimulus payments, new money for small businesses. I guess, Andy, when you look, well, first of all, Steve, what does that mean for credit unions? And then a second question for you, Andy, when regulators see that, does it tend to change how they need to enforce things, whether it's the US or elsewhere, when there's government action like that, when it comes to relief, does that change how regulators view things? But I'll start with you, Steve, on how that affects credit unions.
Yeah, no, the economic relief is welcome. This is something that I think we've been asking for. We see it in our small business owners in particular. I see it around the world, and I see, there needs to be help and economic relief. Now, the question always goes back to the government. How efficient will they be to getting it to those that need it most? Simply just getting money out there and dollars out there, yes, that helps, but getting it to the right people who really need it is what's going to be key. And that's where the United States government, unfortunately, hasn't been as efficient in that process as it needs to be. But again, we welcome the stimulus. It's definitely needed. It needs to go to those people that are being impacted the most.
Yeah, I agree with Steve. I think the banking and financial institution regulators welcome it. I mean, if you get the money into the hands of the right people, I mean, they're going to continue to make their payments, and that helps with the institutional stress that comes from that. And I think Steve is absolutely right. Making sure that money gets into the hands of the people who need it the most and who are most affected by the pandemic is key. And so I think regulators look at that as a positive. I also think Mr. Sattar made a good point. He called it the withdrawal of the fiscal support. How that happens will also determine how well we traverse the trajectory of the pandemic as well. So.
Are you seeing, Andy, I know what Osman Sattar laid out was that Western Europe and the United States, North America particularly, we're going to see higher, kind of double the average maybe that other places do when it comes to credit losses. But would it be safe to say that those markets are also more capable of handling that than let's say if you saw that in emerging markets?
Yeah, I think that's true. I mean, you can look at the size of the fiscal packages that we just had one come out of the EU that was enormous. Them as a collective trying to deal with the problems there, and we've had several packages come out of the United States, and we'll probably get one more when the new administration comes in. Yeah, I mean, to an extent, I would say that's true.
Steve, I know you mentioned that certain things that you predicted, that your team predicted, didn't happen. Are there things in the offing that you're still worried about? I know you said there's some things you can't predict, but are there things that you're looking at and saying, this still concerns me?
Yeah, and I will say what still concerns me, and just this is something here in our region, and I haven't traveled, so I can't tell you whether it's happening in other regions, but just our downtown corridor of our city here are being impacted by the social unrest that's happening. And then, we have other factors of homeless situation. And as everybody has kind of vacated the work and gone remote, it's kind of leaving a ghost town in our central core. And I think that's happening around the United States. I haven't been out, but that's concerning because that will take a while to bring that back. And, part of it is, restaurants and hospitalities and hotels are closed. And then you have workers working remote, and, you have, protests that are occurring, and it's just not creating an environment that's conducive for economic viability. And so that long-term concerns me.
All right, well, we are coming up on the top of the hour here, so I want to be cognizant of people's time. I want to wrap this up and thank everyone for joining us. Osman Sattar from S&P Global Ratings, Steve Stapp from Unitus Community Credit Union, and also our own Andy Price, our Senior Vice President of International Advocacy. And I do want to mention that if you want to let others know that this was a valuable webinar, you can find the webinar in its entirety later today on the World Council YouTube channel. You can see that on your screen. It's youtube.com/woku. And again, this should be up there later today. And again, we hope we will continue to come to woku.org and look for other webinars coming up in the future. Thank you so much for joining us, everyone, and have a great day.